Hey friends, it's Chris. This video is for people who are considering going out and raising venture capital money. In this video, I'm going to talk about firstly, what the hell is venture capital? And secondly, should you go out and raise it? In my time running a startup, I've raised over $20 million of venture capital funding. Was that a mistake? Let's find out. The reason why I want to start with an overview of what venture capital is as soon as you start to understand VC money, you'll get far better at securing it. It's like seeing the Matrix. The main reason to go out and raise venture capital money is to create an outlier, a business that's going to be worth hundreds of millions of dollars or more. And for that, you need a big injection of cash. If that's not what you're building and you're more comfortable building a profitable business that's not going to scale as fast, there are other sources of money that might be more applicable, like angel investors. The way venture capital works is they'll put money into your company in exchange for new shares. That cash then goes into the company's bank account. And voila, you now have money to do things. You can hire people now. You can get an office. You can convince your mum that this startup thing wasn't such a bad idea after all. It's a real job, mum. Well, really, that money is to accelerate product development and to help you acquire customers faster than you normally would be able to. The key here is that venture-backed businesses are designed to scale fast. But why do VCs invest? They invest because they're betting that your company will be worth more in the future. And at some point in the future, they'll be able to sell their shares for more than they bought them for. It's the same as why you'd buy shares in, say, Amazon, but with one key difference. VCs are betting that you may be worth 50 or 100 times more over a 10-year period, not say 20%. It's a big, risky investment, but that is part of venture capital's business model. They'll invest in, say, 10 companies and hope that one of them is going to get really big. So they're taking a binary bet. Either it's worth a lot more in the future, or it's worth nothing. And VCs are okay with you taking this risk to achieve outlier success. Venture capital is normally earlier stage for when you're just getting going, your first 5 years or so, which sounds terrifyingly long, but it goes by pretty quick when you're building a company. And as your company gets later stage, you might raise money from, say, private equity, or even take the company public and sell your shares there. But where does this mysterious VC money come from? It doesn't just come from nowhere. Well, a VC fund is just that. It's a fund. It's a pot of money that gets to invest in a bunch of different companies. That fund is managed by general partners, or GPs, and they decide which companies to invest in. But crucially, most of the fund is not the general partner's money. Most of the fund actually comes from limited partners, or LPs for short. LPs are basically rich people, or high net worth individuals, family offices, which are basically businesses that run rich people's money, pension funds, so it's pretty scary, but yeah, some of your pension is probably invested in a VC. Government funds, even scarier, the government invests into VCs. And companies. So yeah, companies invest into VCs too. Google Ventures is just one example. VCs have to fundraise too, but don't feel too bad for them. Okay, so now we've worked out what VC money is, let's work out if you should try and raise it. The absolute number one reason to raise venture capital money is to post it on your LinkedIn. Hashtag crushing it. No, but seriously, let's go through the upsides. You get a big chunk of cash into your company's bank account. That's about it. So the main value in raising VC money is cash. That money can be amazing. There is no way that my company, Second Nature, would be where it is today without it. Now, some VCs, not all, will try and convince you of their value add, that they're going to bend over backwards and help you build the company with you. And I would just encourage you to treat that with a gentle degree of skepticism. VCs are primarily financiers, so the main value add does come from the cash. And sometimes this value add can do more harm than good. Now, I've been really lucky. The value add that I've had from my investors beyond the cash has been amazing. Everything from being brilliant thought partners in board meetings, to helping us find new investors, to even sourcing new people to join our team. And the exposure to constant feedback from our investors has helped us build an overall stronger business. But I know a lot of founders who were convinced that a new VC was going to change the game for them. And then they ended up with toxic board meetings and really investors who got in the way more than anything else. I've seen it happen, and it can be an unhealthy dynamic. The lesson here is to be careful who you take money from. The opposite of value add is not value less. It's value destruction. And finally, it's worth remembering that your investors aren't going to be in the business day to day. Most of your success is going to come down to you and your team. Now, there is another upside of raising venture capital money. When you go out and get that TechCrunch article about the new funding round, it will convince other people to come and join your company. Suddenly, you're a real business, not just some random startup. Okay, let's get into the downsides. Raising money is really, really hard. I mean really hard. Most founders hate it. I've yet to find a single founder that enjoys that process, except for maybe a few of the psychopathic ones. It's just a grueling process. In my pre-seed round, I pitched 100 VCs, in my seed, 120, and in my Series A, more like 140. And this can kill you. It's personally taken me to burnout more times than I can count. I think hearing no so many times does something strange to the human brain. If Andrew Huberman were here, he would say that fundraising is like running a marathon, but never getting the dopamine rush of crossing the finishing line. That is, until you get that elusive term sheet and everything becomes good again. Keeping your enthusiasm for the 70th pitch when you have a team of 100 people who are all relying on you to raise VC money, it can be stressful. The other problem is raising VC money can lull you into a false sense of security about the strength of the business that you've built. You don't need to focus on your unit economics or your profitability if you've got $10 million sitting in the bank. Yeah, you'll worry about the unit economics later. And then a recession comes. Thirdly, the more money you raise, the higher the expectations. You are now trapped by the growth goals that you laid out with your new investor. And on top of that, you've built a business that probably can't survive without continued waves of VC funding. As Nassim Taleb would say, you've built something fragile rather than anti-fragile that may be able to withstand the ups and downs of the economic climate. VC investors are giving you a binary outcome. Bet big or go home. The company may die in the process, but this is fine for the VC. If they have 10 bets and one of them goes on to be the next Uber, then amazing. But they have 10 bets at this. You only have one. This is good for them, it's bad for you. This is why ultimately, it's worth knowing that this is the game you're playing when you take on this kind of money. If you were to ask me, would I raise VC money again? I definitely would, but I'd only do it if the company didn't need it. I would try and build a company that didn't rely on it. Now, this is my first video, but I'll be doing a whole series on company building. If you're interested in the next one, please subscribe. Any questions or comments, ask them below, and I'll see you soon.